We are now in our seventh year of an economic expansion since the 2008 financial crisis, and yet the central banks of the developed world continue to maintain ZIRP, which is zero interest rate policy, or NIRP, which is negative interest rate policy. And the question everyone asks is, why have they not raised interest rates? Why can't, after 7 years of economic expansion, we already be at 2-3%? Why is it such a big deal that Janet Yellen is just going to potentially raise 25 basis points right now? Well, it's just a matter of putting the global debt situation into context. Here's a chart of the growth of the global credit stock. You can see here, back in 2000, the total debt, and that's including household, corporate, government, and financial institution debt, was at $87 trillion with a T. That has now expanded to about $199 trillion in just 14 years. It basically took 100 years from the entire last century to just reach 87 trillion, and yet in 14 years we have more than doubled that. Why? Why is the debt growing at such a pace? Well, the answer lies with understanding the macro fundamental landscape. So let's take a look at some global risks. In today's marketplace, we have a robust US dollar rally that is driving almost all currencies against the US dollar lower. What are the implications of that dollar rising of that magnitude? When Janet Yellen and the Fed potentially start raising interest rates, the raising of rates is actually an action that slows economic activity. Will that induce a recession in the US down the road? Will China continue to struggle with its credit crisis, and will it emerge into a bubble that bursts? And what are the implications to the emerging markets from such a strong rising US dollar? We continuously see the International Monetary Fund, the World Bank, and even the OECD continue to downgrade global growth forecasts and warn of global deflationary pressures. We continue to see massive Eurozone geopolitics coming to play. We see Japan falling into another economic recession, and we have a Canadian economy that continues to slow, that has not yet resulted in any contraction in real estate. Is that something that will come? Understanding all of this is critical. Why? Well, to us, the financial world revolves around the fundamental macro landscape. What are these macro fundamentals? It's the billions of transactions, the exchange of goods, services, and labor that take place each day around the world, conducted by billions of people, all simultaneously and selfishly trying to do what's in their own best interests. The majority of investors and analysts turn to macroeconomists to gain the insights on the future impacts. But to us, the flaw in the world today is that macroeconomists believe that they can model and forecast these trends, being able to know what billions of people are going to do before they do it. It really is a fool's game to try to know the unknowable. So what is the solution? Rather than forecasting the markets with macroeconomic models, it is far more effective to educate yourself on the rules of the game. Then and only then you'll understand the macro fundamental landscape. Can you learn to understand the unfolding reality before you and the implications of those unfolding trends. Then, when one understands the macro fundamental landscape, they can understand the unfolding reality before them and the implications of those unfolding trends. This allows individuals and investors to be able to react, to protect, and attempt to profit from those trends. So how important is the macro fundamental landscape? To us, it's the driver of everything. As an example, investors that focus on traditional corporate fundamentals and value investing have to realize that the macro fundamentals will ultimately drive the trends that will manifest the investment themes that they're investing in. Equally, the investors that focus purely on technical analysis need to realize that the majority of technical trends that emerge are often driven by those same macro fundamentals. Without trying to diminish the importance of fundamental and technical analysis, it's just that the macro fundamentals are exponentially more important. So how do we look at those macro fundamentals? To us, it always begins with currency. Currencies are the lifeblood of economies, and the strength or weakness of any individual country's currency dramatically impacts that country's economic growth, its balance of trade, the country's capital inflow or outflow, the management of its foreign debt, and its price stability. Now, as those currencies are moving, they have a very direct and immediate impact onto commodity prices. Commodities are these global and international assets, and as any one individual country's currency strengthens or weakens, it takes more or less of those dollars to buy one unit of that commodity. This becomes one of the key precipitating factors in inflationary and deflationary pressure within that country. The underlying trends of these currencies and commodities then drive the macro fundamental trends that drive central banks to step in and attempt to smooth out those variables to drive that price stability and often expressed as specific inflation targets that a central bank is targeting. This is primarily done through conventional monetary policy of increasing or decreasing interest rates, but we have now seen a new period of unconventional method of intervention through what we know as quantitative easing, or known as QE. Changes in interest rates and the subsequent bond buying occurred from the central banks from the QE programs ultimately impact the bond markets, which is the ultimate cost of credit for governments, corporations, and individuals. As central banks and the bond market determine the cost of credit, it ultimately translates into the real estate market. While there's a number of non-financial variables such as demographics, immigration, and all sorts of things that affect the real estate markets, there are two key financial variables that we have to be aware of, and that's the availability of credit and the cost of credit. If you have a healthy banking system that makes mortgages readily available, and you have a continuous lowering of interest rates, allowing every refinancing to be done at cheaper and cheaper rates, it allows real estate to be in a very natural, appreciative state. And while that is its natural state, we always want to be aware when that credit cycle has been interrupted. And so ultimately, each of these sectors have a very direct and material impact on the ultimate valuation of stocks. And when you're looking to forecast or buy a stock or invest in a stock, one must always try to put it into the context of those macro fundamentals. At Learn to Trade Global, we put together a 4-day Macro Masters program where we cover everything from understanding the global economic system, everything from understanding central banks to commercial banks, understanding the situation that every global country is in, and understanding many of those macro fundamental variables such as jobs numbers, manufacturing inventories, inflation, GDP growth. At the same time, we'll cover understanding money, currencies, inflation, constant dollars, the debt, understanding the bond markets and interest rate trends. We then proceed to look at the commodity markets and real estate markets, looking at everything from trends in basic materials, understanding the food markets or energy markets, and understanding precious metals and gold and its significance on the economies. We then look in real estate, not necessarily as an individual investment, but rather the major trends of real estate and ultimately their impacts on the economies. And on day 4, we look at global equity markets, understanding the stocks, the indices, and industries and sector trends, and how the different sectors and industries impacted by different macro conditions. We then turn around and look at those macro fundamentals, correlations, breadth, and relative strength, and try to really understand how to make really good stock decisions and investment decisions based upon putting all of those variables all together. We're going to be running the Macro Masters program starting Tuesday, December 1st, running in the evenings from 7 p.m. to 9 p.m. On the December 1st, December 3rd, December 8th, and December 10th. Anyone that would like to reserve your spot, please reach out to us, and we'll get you registered and started into the program. We'll see you then.